What's at stake when you're out of compliance with worldwide income and information reporting? That's the subject of this series. The first thing I need you to understand is that if you're out of compliance with worldwide information and income tax reporting as a U.S. taxpayer, you could potentially be looking at a very explosive situation. Unfortunately, the following fact pattern has been found sufficient in case law to criminally prosecute previous taxpayers that have found themselves in this situation. A combination of 3 badges of fraud, when added together, is sufficient to sustain a criminal prosecution for income tax evasion and willful non-filing of foreign bank account reporting forms, TDF 90-22.1, which went on to become FinCEN Form 114. The only change between the two is one is done in electronic format online, the other was in paper. First factor out of the 3 is non-filed FBARs, or FinCEN Form 114s. This form is required anytime you have greater than $10,000 on deposit in a foreign account in any combination of account balances. You take the accumulation of every account balance you have offshore, you add them together. If that's over $10,000, you have to complete this form. This form by itself is kind of innocuous. They'll hit you with a $10,000 penalty if you don't complete this form. The second factor in this trio of factors, or badges of fraud, that'll get you in trouble, is you have some sort of non-reported foreign income along with the non-filed FBARs. It starts to look like you're not telling the US government about the foreign accounts because you're trying to hide the fact you've got these non-disclosed sources of foreign income that you're not reporting for income tax purposes. This starts to look like a conspiracy or an attempt to evade taxes to the US government. The non-filed foreign income tends to come from investments in foreign markets, stocks, bonds, mutual funds, capital gains, ordinary income from interest, dividends, that sort of thing. Or it could be an offshore investment of some type, like real estate assets. It could look like you went out and bought a bunch of rental real estate in Switzerland right next to a ski resort, and you're not reporting the rental income off of that rental property, combined with not telling the US government about the fact you've got an account that you're depositing all these profits in offshore that went above $10,000. It could also look like you went out and started a foreign business where you're running a full-on offshore business and you haven't complied with any of the foreign information reporting concerning starting that business, funding that business, whether you're dealing with a controlled foreign corporation, non-controlled foreign corporation, any type of offshore trust formation. All of this offshore activity, if it's generating taxable income in the United States that's not being reported for US tax purposes, coupled with non-filed FBARs, that starts to look like a very dangerous fact pattern. What you also need to know in this area is that there's a set of regulations called the PFIC regulations, Passive Foreign Investment Company regulations. In my opinion, these regulations were created for one purpose and one purpose only: to make the record-keeping requirements on an offshore mutual fund so onerous that nobody in their right mind would invest funds offshore in a mutual fund. That the compliance headaches would make you invest in US-based mutual funds, which is really where they want your money anyways. There are 2 types of offshore investment activities in foreign businesses that need to be reported. You basically have a controlled foreign corporation regimen, where if you own 51% or more of an offshore corporation, or you own that through related parties and you're up above 51%, that's considered a controlled foreign corporation. You're going to have to file a Form 5471 for information reporting purposes, and that's how that income is brought onto your US domestic return each year, is through a 5471. If 5472 is required if you have a US-based corporation that has greater than 25% foreign ownership. This is another way you can find yourself tripping on these offshore reporting regulations. Certain transfers of property to offshore corporations trigger a Form 926 tax filing, where you have to report the transfer of an asset to an offshore entity. There's a Form 8865 for reporting an investment in a foreign partnership. Any type of foreign real estate is reportable for U.S. tax purposes. This includes the renting of that real estate, the rental income has to be picked up, or the buying, selling, developing of offshore real estate. Anytime there's a realization event, as if it would have happened on U.S. soil, it's very similar to if it happened on foreign soil. As a U.S. taxpayer, you're taxed on your worldwide income. Doesn't matter where you make money, anywhere in the world, if you make money, it's reportable on your U.S. tax return. The U.S. is only amongst a handful of nations that do this, and therefore, if you're a recent immigrant to this country, that explains a lot if you're not in compliance with the law. Income from foreign retirement plans is reportable for U.S. tax purposes. Even though you earned all of that retirement pay offshore and then immigrated to the U.S., that income is reportable for U.S. tax purposes. If you have offshore sources of retirement income that you're not reporting for U.S. purposes, and you're accumulating that in an offshore account, and that account goes above $10,000, you don't tell them about the account, you don't tell them about the income, it starts to look like fraud. Offshore sources of income similar to U.S. Social Security may be taxable depending on the treaty between the foreign country and the United States. Also might look like fraud if you're accumulating that in an offshore account and not telling the U.S. government. One fact pattern I've seen over and over again in this area that's gotten a lot of people in trouble is foreign inheritances. I'll get more into that later. But basically, a foreign inheritance can be non-taxable in the U.S. if it's handled correctly. A lot of people are not telling the U.S. government about foreign inheritance, thinking they're going to be hit with an estate tax they probably wouldn't have been hit with in the first place. And then they hide the existence of the offshore assets, the offshore accounts, the offshore income, because they're trying not to get hit with an estate tax. This will wind up in income tax evasion and foreign reporting fraud, which is a crime. The third badge of fraud that has been used to create a criminal prosecution is there's a checkbox on Schedule B where you report your income and your dividends. If you don't report the income on Schedule B from a foreign account, that's one badge of fraud. The second badge of fraud is there's a checkbox on Schedule B that says, do you have a foreign account, yes or no? If you answer no to that and you really have a foreign account, that's a badge of fraud. If you answer yes to that question, you're supposed to include a TDF 90-22.1, an F-bar, and tell them on that line where that foreign account is, what country it's in. If you don't do that, that's another badge of fraud. In recent years, there's an additional badge of fraud that may appear in your fact pattern. There's Form 8938, which is a FACTA filing required form. Anytime you have financial assets offshore greater than $50,000 in aggregate, you're supposed to fill out that form. If that's missing and you have more than $50,000 in aggregate assets offshore, that's another badge of fraud. The 8938 is the Statement of Foreign Financial Assets. Let me give you a quick history of how this issue became on the forefront of the tax authorities, both the civil and the criminal sides of the IRS as of recent years. About 6 years ago, there was an employee of UBS that was about to lose a job. He said he couldn't afford to be without income, so he stuck a flash drive in a computer. He downloaded 50,000 of the highest account balances that U.S. taxpayers had in a Swiss bank called UBS and sold it to the U.S. government for several $1,000,000. This led to an eye-opening experience that the wealthy were having offshore deposits that were invested in foreign markets, and they were making their capital gains and their dividends and their interests and their stock splits and all sources of way in their margin trading. Any way you can make money in the U.S. domestic stock market, they were making their money in an offshore stock market and not reporting it for U.S. tax purposes. Through that investigation, it came to light that many banks around the world in tax haven countries, Switzerland being the #1 tax haven country at the time, were telling taxpayers all over the world, put your money in Switzerland. The entire world won't know it's here. We'll never tell them. Our Swiss bank laws prevent us from telling your government that your money's here. You can put your money in our stock market and you won't have to pay tax on your money that's making you money because we're not going to tell anybody about it. This was fostering income tax evasion on a worldwide scale, and Switzerland was not the only tax haven country doing it. In my opinion, what happened is the IRS, upon recognizing this was happening, went to Congress and said, give me the most draconian set of civil and criminal liabilities known to man so that I can force people to fix this problem if they have it. There were lots of laws on the books already that would punish this type of behavior. 7201 tax evasion. You had filing a false tax return under 72061. Failure to file a tax return under 7203. Willful failure to file an FBAR under USC 31, section 5322. Conspiracy to defraud the U.S. under 18 USC sections 286 and 371. The combination of all these criminal sections that I just described can earn you anywhere from 3 to 10 years in prison up to a $500,000 fine. Amongst other things the government could do to you, if they deemed your non-filing of the FBAR to be willful, they can hit you with the greater of 50% of the account balance or $100,000. There is some case law that says they could hit you for this 50% penalty for 5 years consecutively, which is 250% of the offshore account balance. In recent years, the government has tamped this down a little bit and said in no circumstances should it exceed 100% of your offshore account balance. What you need to realize is this the high water mark of your offshore account balance during the 6-year exposure period. There's a 6-year statute of limitations for tax crimes surrounding the FBAR. So if at one point your account balance was worth $3 million, but today it's worth $50,000, they could get you for $3 million, not $50,000. There's also civil penalties surrounding all of those foreign information reporting forms I was mentioning earlier. Most of them are about $10,000 per year for not filing one of those forms. If you have offshore businesses, a multiple of these form reportings could be due in any one tax year. The government also has at its disposal a civil fraud penalty. In other words, if it's deemed that you underpaid your tax liability by $1,000, but fraud is the reason you did that, you could be looking at $1,750. Here's a situation I've seen my clients trip on time and time again. If you have a foreign inheritance or you receive foreign gifts that exceed $100,000 in any one tax year, a Form 3520 becomes required. If you fail to file this form, a penalty of anywhere from 25% to 35% of the taxable gifts or inheritance that you received in that year could be assessed against you. So if you got $1 million of gifts in one year and you don't do the 3520, they could hit you with as high as a $350,000 penalty.